Alright, so in our last video, we bought a $300,000 house. So that, as you remember, it goes under your assets. So we'll put $300,000 and we'll mark it as a house. So we were able to do this by going to the bank, getting a home loan. So they checked out my credit score, they went over my different income streams and found that I was a great guy and worthy of this loan, so they gave me the money. So now what your balance sheet looks like is you've got your $300,000 house, you've got $225,000 that you still owe to the loan, to the bank, home loan, and then your equity is going to be $75,000. So we really haven't seen that equity number move. So right now it looks like my entire life is this $300,000 house, in which a lot of cases that is someone's entire life because this is the largest asset that you'll ever have. Can't really quantify good looks, or else I'd put that on there. Maybe another video. So we still owe the bank $225,000, and this makes up all of your liabilities. If we were to resolve all of the liabilities, this is where we're getting that equity. So your equity is going to be your assets minus liabilities. That's where you get that calculation. So, oh yeah, one other thing about this $225,000 that the bank loaned us. The bank is only loaning us that to purchase the house. We can't just go out and spend the money wherever we want. We can't fly out to Vegas for the weekend and blow all our money in gambling. The reason is the bank needs this loan based on a house. So the problem is if we default, they're going to take your house and then they'll be able to auction that off. So say that I lost my job, or just for any reason I disappeared and couldn't make my payments anymore, they take the house, put it up for auction, and then they're hoping that they're going to be able to get their money back. So now let's think about a situation where the value of your house is actually going down. So a neighbor of yours has an identical house, and they just put it up for sale and it sold for $240,000. So now you've got to take a look at your own situation and draw out your new balance sheet. So now you've got your assets, you've still got the house, however it's identical to your neighbor's that just sold for $240,000. So now you have a $240,000 house. Your liabilities are your home loan. I don't know why I wrote that out. Let's just put L. Make it faster. Your liabilities are still $225,000 that you owe to the bank, and your equity is now $15,000. So you still have the same house. It just lost $60,000 of its value, though. All this loss, you'll see, was taken out directly out of your equity. So your equity takes all the risk in a home buyer's situation. Of course, there's risk and reward. So now let's say that you default on your loan, and the bank's still going to get their money. So they're going to take your house, they're going to auction it off for $240,000, so they'll get $240,000. So they also eat up your equity. So this explains why the banks are usually going to require you to have a down payment. It's just to make sure that they're going to be covered and they're going to get as much of their money as possible. Because this could have gone down even more than this value, which is kind of what we saw around 2009. So now let's think of a more positive situation. Let's think about a situation where your house, your neighbor just sold their house, and they didn't sell it for $300,000, just like your house, but they sold it for $450,000. So you're thinking, that's pretty good. I've got a nice house now. So now your liabilities are $225,000 that you still owe to the bank, so that doesn't change. However, your equity is now $450,000 minus $225,000. You have equity of $225,000. So the value of the home went up 50%. So it went from $300,000 to $450,000, but your equity went up 3 times. It's up 300%, from $75,000 originally to $225,000. And this explains why leveraging your debt to have a home equity loan is so powerful. We have a ton of equity now, and this is primarily what was driving our economy in the early 2000s. So now you're thinking, what can I do with this equity? How can I turn it into cash? How can I have fun with this? I'm feeling rich. Let's say that you're going to the bank and you're like, hey, what can I do? So they're thinking you can have a home equity loan. You go to the bank, you show them all the equity that you have, and they're interested, right? So you have to have this requirement that you have at least 25% equity in your house, which in this case we do. We've got 50%. So they're just making sure that if you default, that they're going to be covered here. So you're going to take the money out of the equity of your house. They want, say that they'll give you 75% of the value of your house. In this case, it would be times 75%. You want this in cash. This is going to be $337,500 that you're going to be able to increase your loan on. Well, the increase of your loan is going to be the $337,000 minus the original loan amount. So this would be the entire loan amount. So now we're going to subtract your $225,000 original loan, and we're going to come up with $112,500. So this is the amount, the extra amount that we can now borrow. And you're taking this money again directly out of the equity of your house. So now you can have this in cash. So we can redraw your new balance sheet now that we have all this cash. Okay, you've got your $450,000 house, your newly acquired $112,500 in cash, your home loan is still going to be $225,000, and your home equity loan, that's your new one, is going to be $112,500. In your equity overall, this is going to be added up together, subtract out your liabilities, and I bet you can guess this number. It's going to be $225,000. So this makes sense. Your equity shouldn't change, but you're feeling rich. Now you want to keep up with your other rich friends. You want to go out to Vegas, stay at the finest hotel, and maybe gamble the night away, right? So you spent $50,000 on this vacation. So where does this money come from? This is going to be taken directly out of your cash. So now we can redraw this to be this is going to be $62,500 cash. And your equity has gone down because of your extravagant vacation. Your now net worth is only $175,000. So your assets went down, directly dropped your equity. The bank's liabilities, you'll notice, still remain the same. You still owe the banks no matter what. They're not gonna think, hey Sam, you did a great job getting all that equity. We're gonna pay for your vacation. So this is what really drove the economy in the early 2000s. People were borrowing against the equity of their house and using this to pay for, in some cases, they were paying for more houses or vacations or whatever they were buying. The problem is when the housing market drops in value and you default and your neighbors default and everyone else defaults, then the bank has a bunch of houses with no one to sell to. This is what really started to happen in 2008. So I really hope that this has helped. I'm going to go ahead and wrap this up. I hope this has helped you in your home buying, purchasing decisions. Just some things to think about. Think about writing out your own balance sheets. Also, it would mean a lot to me if you would subscribe to my channel. I'm going to have some more educational videos here coming up shortly. If you found any value in this, please share this. I'll go ahead and I'll see you next time. Thanks.